Understanding investment assets. In every economy, there are two types of participants: those who exchange time for money and those who own assets. One group works within the system, the other owns parts of the system. This distinction is subtle at first, but over time, it becomes everything. Because income can be earned, but wealth is built through ownership. And ownership begins with understanding one thing: investment assets. Not as buzzwords, but as the underlying structures that shape financial power in the real world. At its most precise level, an investment asset is a resource you allocate capital into with the expectation of generating future economic benefit. That benefit appears in two primary forms: cash flow, recurring income, and appreciation, increase in value over time. But this definition is incomplete without context, because the market is full of illusions. Many things appear valuable, but function as liabilities. The distinction is not emotional, it is functional. An asset strengthens your financial position, expands your economic capacity, compounds value over time. Anything that consistently drains resources, regardless of how desirable it appears, is not an asset. The asset framework. To understand the system clearly, all assets can be grouped into four structures: financial assets, real assets, business assets, and alternative assets. Each category behaves differently. Each responds differently to time, to risk, and to economic cycles. Financial assets. Financial assets are intangible, but they dominate modern wealth creation. They represent claims on cash flow, ownership, or future value. A stock represents fractional ownership in a company, not a price, not a symbol, ownership. When you acquire equity, you are participating in revenue generation, profit creation, and strategic execution. The market fluctuates daily, but businesses evolve over years, and long-term value is determined by earnings growth, competitive advantage, capital allocation, and leadership decisions. The disciplined investor looks beyond price and studies the engine behind it. Fixed income, bonds. In contrast to equity, fixed income positions you as a lender. You provide capital in exchange for structured, predictable returns. Governments and corporations issue bonds to finance operations. Investors receive interest payments, return of principal. Lower volatility, lower return, but essential for stability. Cash and liquidity. Cash is often underestimated. It provides flexibility, optionality, and protection. But it also carries a silent cost. Inflation reduces purchasing power over time, so while cash protects, it does not build. Real assets. Real assets exist within the physical economy. They are tied to necessity and constrained by supply. Real estate. Real estate remains one of the most enduring asset classes. It combines income generation through rent, appreciation through market demand, and leverage through financing structures. This combination creates a unique advantage: control over large value assets with limited initial capital. But performance depends on location, market cycles, and operational efficiency. It rewards strategy, not speculation. Commodities. Commodities are foundational inputs. They include energy resources, precious metals, agricultural products. They do not produce income, but they preserve value, particularly during inflation and instability. They function as anchors in uncertain environments. Business assets. At the highest level, Wealth is not accumulated, it is engineered through business assets. Operating businesses. Owning a business means controlling value creation. You influence revenue streams, cost structures, market positioning, and growth trajectory. This is active ownership. It carries risk, but also the highest potential for return. Intellectual property. Ideas can be converted into scalable assets. Books, courses, digital platforms, content systems. Once created, they can generate income repeatedly without proportional effort. This is leverage through creation. Systems and infrastructure. The most sophisticated assets are systems, processes that generate outcomes, independent of constant involvement. A well-designed system produces consistent results, scales efficiently, and reduces reliance on time. This is where effort transitions into structure. Alternative assets. Beyond traditional frameworks, exist assets driven by innovation and perception. Digital and emerging assets. These include decentralized systems, digital platforms, and new financial technologies. They are highly volatile, rapidly evolving, and structurally disruptive. They represent transformation, but require disciplined risk management. Collectibles and scarcity assets. Certain assets derive value from rarity and demand. Art, luxury items, cultural artifacts. Their pricing is influenced by scarcity, narrative, and market sentiment. Less predictable, but often resilient over long periods. Risk, return, and portfolio structure. No asset exists without risk, and no return exists without exposure. The relationship is direct. Higher return requires higher uncertainty. Lower risk limits upside. The objective is not perfection, it is structure. A well-constructed portfolio balances growth assets, income assets, defensive assets, and liquid reserves. This is diversification, not as a concept, but as a discipline. The investor mindset. The difference between participants in the economy is not access, it is perspective. Some focus on earning, others focus on acquiring. Some spend, others allocate. Over time, these decisions compound, quietly, consistently, until the gap becomes undeniable. Every company you see, every building you pass, every system you depend on exists because someone chose to own instead of only participate. Assets are not abstract. They are the foundation of control in the modern world. If you're serious about understanding how money actually moves, how wealth is actually built, and how power is actually structured, then this is where that journey continues. Subscribe to Real World Business School, where we break down complex systems into clear, practical intelligence, so you don't just earn within the system, you learn how to position yourself to own it. Because in the end, those who understand assets don't chase opportunities, they become the ones who hold them.